What is a money market fund? A money market fund is a type of investment that works a bit like a super safe savings account, but with a twist. Instead of keeping your money in the bank, the fund invests it in short-term, low-risk things like government bonds, treasury bills, or very secure loans between big institutions. The goal? To keep your money safe and earn a little interest along the way. The fund earns this interest by lending to governments or large organizations at low rates, and then passes most of those returns on to you. It's often used by people who want easy access to their cash but still want it to be doing something useful. Why does it matter? Money market funds are important because they give you a low-risk place to park your money, especially when you're waiting to invest or just want to keep it handy. They're popular with cautious investors, businesses managing their cash, and even pension funds. In times of uncertainty, they offer a sense of stability. You might hear investors talk about cash drag, when money is just sitting idle, earning nothing. A money market fund helps you avoid that. Your money stays accessible, but it's also gently working for you. Returns from money market funds also tend to rise when interest rates go up, but they might not always keep pace with inflation, so over time your money could still lose a bit of its buying power. Emotionally, they offer peace of mind. You know your money isn't locked away, but it's not just sitting still either. Here's a simple example. Let's say you have £5,000 that you don't want to invest in shares just yet. But you don't want it just sitting in your current account either. You put it into a money market fund. The fund spreads your money across a range of short-term, low-risk investments, like lending money to the UK government for a few weeks at a time. After a few months, you might have earned a small return, maybe £50 or so, depending on interest rates. It's not about big profits, it's about keeping your cash safe and slightly more productive than a piggy bank. What else should you know? Money market funds are very low risk, but they're not the same as a savings account. They're not protected by the Financial Services Compensation Scheme, FSCS, and their value can, in rare cases, go down slightly. That said, they're usually very stable. The investments they hold are short-term and high quality, things like government bonds or bank-issued debt that matures in weeks or months. They're also highly liquid, which means you can usually get your money out quickly, often the next working day. You can access money market funds through investment platforms or cash management services. In some cases, they're part of a cash ISA, a money market ETF, or included in a broader multi-asset fund. Investors often use them as a place to hold cash between buying and selling other investments. And big companies, even some governments, use them to manage large reserves of cash safely. To sum it all up, a money market fund is a low-risk investment that keeps your money accessible while earning a small return. It's not designed for big growth, but it is ideal for short-term goals, stability, and avoiding idle cash. Perfect when you want to park your money somewhere calm while you decide what to do next. Thanks for watching this video. Not sure where to go from here? You don't need another video, you need a plan. Grab the free 5-day series below and start investing with confidence. The link's right here on screen and in the description, don't miss out.